Every second, billions of dollars exchange hands, fortunes rise and fall. But what drives this high stakes game? Welcome to the world of the stock market, a pivotal part of the global economy. Let's begin our journey. Let's start with the basics. In the stock market, companies list their shares, offering a portion of their ownership in the company to the public in exchange for capital or money. This allows the company to raise money to fund new projects, pay debts, or expand its operations. On the other hand, for investors, this is an opportunity to buy a stake in the company's growth. For example, if the company prospers, so does the shareholder, but there's always risk involved. If the company fails or its value decreases, so does the investor's stake. Additionally, stocks aren't limited to a single company. Imagine owning a slice of hundreds or even thousands of stocks in one trade. That's the power of exchange traded funds, or ETFs, which are investment funds that trade like stocks but invest in a diversified portfolio of stocks in various companies. For example, the S&P 500 ETF invests in the 500 largest US companies, while the Magnificent 7 ETF focuses on top tech giants like Apple, Microsoft, and Meta. Investing in these ETFs means you hold a small part of the companies that the ETF invests in. With ETFs, investors can diversify easily to mitigate risk and track overall market performance, allowing them to gain market-wide returns on a single investment. Now let's take a look at some factors that drive the stock market and its prices. Remember, it's not just luck. First, we have economic indicators. Measurements like GDP, inflation, and interest rates impact stocks. For example, higher interest rates makes borrowing costly, often leading to market declines. Next, we have company fundamentals. Earnings reports drive stock prices. Strong earnings boost stocks, while weak reports cause declines. Next, we have geopolitical events. Trade wars, conflicts, and elections create fluctuations in the market. For example, the 2018 to 2019 US-China trade war caused major swings in tech and agricultural stocks. And finally, we have market sentiment, which is how the public feels about the market. For example, the news, social media, and psychology can all influence stocks. When COVID-19 struck, it triggered panic sell-offs, causing a significant decrease in the market prices. Finally, let's talk about how you can get started investing in the stock market. It might seem overwhelming at first, but it's simpler than you think. First, open a brokerage account with platforms like Fidelity, Vanguard, or Robinhood. Next, set a budget. Only invest what you can afford to lose. Start with index funds or ETFs, like I mentioned before, for diversification and lower risk. If you prefer individual stocks, make sure you research company fundamentals like earnings, growth, and the industry trends. And finally, make sure you're thinking about the long term. Successful investing is about patience and consistency, and it's not always quick. In conclusion, the stock market is a powerful, unpredictable force, but with the right knowledge and strategy, anyone can take advantage of it for their own gain. It's about understanding the fundamentals, watching trends, and staying informed. Whether you're looking to build wealth, secure a financial future, or simply understand the world around you, the stock market offers vast opportunities. Are you ready to take your first step into the world of the stock market?